In this video, you'll learn how to prepare a cash flow statement using a direct method example with the help of the income statement and the balance sheet, along with some T accounts. Hey viewers, I'm James and welcome to Accounting Stuff. This is a place where I regularly post videos teaching accounting for beginners. There's a whole playlist of these videos which you should be able to find up here in the corner. I'm posting more and more of these videos all the time, so consider subscribing to avoid missing out. If you're a regular viewer here, then we pick up from where we left off last time with preparing a cash flow statement using a direct method example. Previously, I showed you a cash flow statement for the Chudley Cannons Quidditch team, along with its corresponding income statement and balance sheet. But if you missed part one, there's a link to that up here as well. In this video, we're going to rewind a bit and prepare that same cash flow statement using T accounts and both of these reports. We're going to use the direct method as we work out each number as we piece it together. We're going to start off with the easy ones and move on to the harder calculations as we progress. So I recommend watching this video through until the end to get a clear picture of the whole process. Let's begin. So here we have the cash flow statement for the Chudley Cannons, and the plan is we're going to recalculate all of these numbers directly from the income statement and balance sheet for the same period, the 31st of December. We will start at the top with cash flow from operating activities and work our way down through all three sections to cash flow from financing activities. We are using the direct method today, so cash flow from operating activities mirrors the layout of an income statement prepared under the cash basis. So we have cash receipts from customers at the top, which reflect our sales, and below that we have cash paid to suppliers, employees, and the rest of the expense types. Operating activities are the principal revenue generating activities of a business. So this section shows the cash that we receive or pay out during the course of our regular business. The first line item that we're going to calculate is cash receipts from customers, and to do this, we're going to need to look at the movement in our accounts receivable balance. I said in the intro that we'll need some T accounts, so let's draw those out. Accounts receivable is an asset, which is the A in dealer, so it's a normal debit account. That means our opening balance, or our balance brought forward, goes on the left side of the T account because debits always go on the left. The accounts receivable balance increases as we make revenue because when we credit sales, we debit accounts receivable. So sales go on the left side as well. And finally, the closing balance, or the balance carried forward, also goes on the left because it's a normal debit account. Opening and closing balances for normal debit and credit accounts should always be on the same side as each other. On the credit side of the T account, which is on the right, we have cash receipts from customers. Cash received from customers reduces our accounts receivable, and this is what we're looking to solve for because cash receipts from customers ties back to our cash flow statement. Now we've laid out our T account, let's enter some numbers. We get our opening balance from the balance sheet for the previous year. In this case, accounts receivable were $98,000 as at the 31st of December for the prior year, so we can write this down in the T account. Sales come straight from the income statement. This year the Cannons made sales of $250,000, so we need to debit accounts receivable by $250. And finally, our closing balance comes from the balance sheet, this time from the current year. Accounts receivable at the end of the current year were $120,000. So that goes on the left at the bottom of the T account. Now we only have one missing value, cash receipts from customers, and we can work this out using some basic maths. Our closing balance of 120 less our sales of 250 less our opening balance of 98 gives us minus 228. The negative sign signifies that this is a credit, so we write this down on the credit side of our T account. As you can see, this ties back to the 228 that we have in our cash flow statement. All is well. Next, I'm going to skip over cash paid to suppliers and return back to it later in this video because it's actually one of the harder balances to calculate. So instead we move on to cash paid to employees. The balance sheet account that we're going to need for this one is salaries payable. Salaries payable is a form of liability, the L in dealer, so it's a normal credit account. That means our opening balance goes on the right-hand side of the T account because credits always go on the right. The balance on this account increases as the salaries expense goes up because when we debit the salaries expense, we credit salaries payable. so these go on the right. And lastly, the closing balance joins the opening balance on the right-hand side because we have a normal credit account. We are looking to solve for cash paid to employees, which will show as a debit on the left-hand side of this T account, because when we pay out cash to employees, we reduce salaries payable. This is the only unknown value for us at this stage because we can easily pull the opening and closing balances from the prior and current year balance sheet, and we can get the salaries expense from the current year income statement. So let's do that. The prior year balance sheet shows a closing balance in salaries payable of 30. The current year income statement shows a salaries expense of 80, and the current year balance sheet shows a closing balance in salaries payable of 42. Let's write these down in the T account and work out cash paid to employees. Our closing balance of -42 less the salaries expense of 80 less the opening balance of 30 gives us cash paid to employees of 68. This number is positive, so we debit the T account by 68. And does it tie back to our cash flow statement? Yes, it does. Perfect. Next up, we need to work out interest paid. We're going to run through this one a bit quicker because the balance sheet account that we use to work this out is interest payable, which is also a liability. So the process is very similar to cash paid to employees. That means that the opening balance, the interest expense, and the closing balance all go on the right-hand side of the T account because interest payable is a normal credit account. On the left side, the debit side, we are looking to solve for interest paid, which should tie back to the cash flow statement. We are again going to look for the opening and closing balances in the respective balance sheets and for the interest expense in the income statement. So here we go. The prior year balance sheet shows a closing balance in interest payable of 2. The current year balance sheet shows a closing balance in interest payable of 3, and the current year income statement shows an interest expense of 8. So let's enter these into our T account to work out interest paid. Our closing balance of -3 less the interest expense of 8 less the opening balance of 2 gives us interest paid of 7. It's positive, so we debit the T account by 7,000. When we check back against the cash flow statement, we can also see interest paid of 7,000, so it matches. The last line in cash flow from operating activities is income taxes paid, which we will work out now. The balance sheet account that we're going to need for this one is income tax payable, and since that's also a liability, the process is going to be very similar to the previous two examples. The opening balance, the income tax expense, and the closing balance go on the right-hand side of the T account because we are dealing with a normal credit account. On the debit side, we have income tax paid, which we are solving for. The opening and closing balances will again come from the balance sheets, and we will get the income tax expense from the income statement. The prior year balance sheet shows a closing balance in income tax payable of 4. The current year balance sheet shows a closing balance of 6, and the income statement shows an income tax expense of 9. We enter these into the T account to work out income tax paid. Our closing balance of -6 less the income tax expense of 9 less the opening balance of 4 gives us income taxes paid of 7, so we debit the T account by 7,000. And this ties back to income taxes paid in the cash flow statement. Whew, how do you find that? Brace yourselves because we're about to take on something a bit more challenging. We're going to head back to cash paid to suppliers, which we left out earlier, and I'll show you how to calculate it. The balance sheet account that we need here is accounts payable, which is a liability. Now you might be thinking, but James, we just did 3 liability T accounts. Isn't the process going to be exactly the same? Bear with me for a moment and I'll explain why it's different. We lay out the accounts payable T account as we've done before. The opening balance, inventory purchased, and closing balance go on the credit side, and cash paid, which we're solving for, again goes on the debit side. We can easily pull the opening and closing balances from the prior and current year balance sheet. In this case, we have an opening balance of 95 and a closing balance of 105. So all we need now is inventory purchased, and we're on our way. But how do we find inventory purchased? There isn't an inventory expense in the income statement. All we have is cost of goods sold. Bummer. What we have to remember here is that we're accounting using the accrual basis. And under the accrual basis, we apply the matching principle, which states that revenue and all expenses incurred in order to generate that revenue need to be recognized in the same accounting period. Now, what that means for us in the context of this example is that when we purchase goods from suppliers that we intend to sell, we can't immediately recognize an inventory expense in the income statement. That's because our intention is to sell our inventory in order to generate sales. And if we're generating sales, then the matching principle is telling us that we need to recognize those sales and their related expenses in the same accounting period. In order to do that, we need the help of another account, inventory. Having an inventory account means that we can store the costs of all goods that are intended to be sold as a debit balance in the balance sheet. And when they are sold, we decrease inventory in the balance sheet and increase cost of goods sold in the income statement. Let me explain this using an inventory T account. Inventory is a form of asset, which makes it a normal debit account. So the opening balance, inventory purchases, and the closing balance go on the debit side. On the credit side, we have cost of goods sold. We can easily find the opening and closing balances by referring to the prior and current year balance sheet. Here we have an opening balance of 68 and a closing balance of 94. Which we will write down in our T account. And we can find cost of goods sold in the income statement, which in this case is 60. So we write 60 on the credit side of the T account, because when we sell inventory, we debit the income statement to recognize the expense, and we credit inventory in the balance sheet to reduce our assets. That leaves us with inventory purchases, which we can work out using the other numbers. A closing balance of 94, less the opening balance of 68, and adding back cost of goods sold of 60 gives us inventory purchases of 86. So we debit the T account by 86. You might have noticed already that it was inventory purchases that we were looking for in our accounts payable T account. So we can copy the 86 over to the credit side of accounts payable, because when we purchase inventory, we debit inventory to increase it and credit accounts payable to increase the amount that we owe to suppliers. Now that we've worked out that number, we're on the home straight to calculating cash paid to suppliers. Our closing balance of negative 105 less inventory purchases of 86 less our opening balance of 95 gives us cash paid to suppliers of 76, which goes on the debit side of the accounts payable T account and ties back to our cash flow statement. Ouch, did you survive that? Cash paid to suppliers is definitely one of the hardest numbers to calculate under cash flow from operating activities. If you'd like to learn more about accrual accounting, then I'll throw a link up here to a video that I've made about it previously. So that was cash flow from operating activities, and when we subtotal all of these numbers that we worked out, we can see that the Cannons have generated $70,000 of cash inflow from their core operations. But hold your horses, we're not done yet. Next up, we have cash flow from investing activities. Investing activities most commonly relate to the sale or purchase of non-current assets, or investments in stocks and shares that sit outside of a business's core operations. In this cash flow statement, we have cash flowing out of the business from the purchase of plant, property and equipment, or PPE for short, and cash flowing back in from the sale of PPE. You might have guessed it already, but the balance sheet account that we need to calculate these numbers is plant, property and equipment. This account is an asset, which is the A in dealer, so it's a normal debit account, and therefore our opening and closing balances go on the left-hand side. On the credit side, we have the depreciation expense because the value of non-current assets reduce as they depreciate. Credit non-current assets in the balance sheet, debit depreciation expense in the income statement. Now, I don't want to overcomplicate things in this tutorial, so we're going to keep PPE simple and make a few assumptions at this point. We're going to ignore accumulated depreciation, assume no gain or loss on disposal, and that all cash related to these transactions has changed hands. And finally, that the Cannons spent $70,000 purchasing PPE this year. I know that's a lot of assumptions, but we don't have a fixed asset register for this example, so we'll leave it at that. I'll probably do a whole video in the future covering fixed assets and depreciation. Now that we've cleared that up, all that's left to include are cash paid to purchase PPE and cash receipts on the sale of PPE. The prior year balance sheet shows a closing balance in PPE of 202. The current year balance sheet shows a closing balance of 234, And we can see that the depreciation expense in the income statement was 23. I just said that we can assume that the Cannons spent $70,000 on the purchase of PPE and that all their cash has changed hands. So we would credit cash by 70 to decrease it and debit PPE by 70 to increase it. That leaves us with cash receipts from the sale of PPE on the credit side, which we now need to solve for. A closing balance of 234 less cash paid of 70 less an opening balance of 202 and adding back the depreciation expense of 23 gives us cash receipts on the sale of PPE of 15. So cash would be debited by 15 to increase it, and PPE would be credited by 15 to decrease it. Both cash paid to purchase PPE and cash receipts on the sale of PPE tie back to our cash flow statement. And when we subtotal all of these, we see a cash outflow of $55,000 from investing activities. Cash flow from investing activities is an important section of the cash flow statement because it can significantly offset the cash flow generated from operating activities. Last up, we have cash flow from financing activities. And don't worry, we've got all that hard work out of the way. This section's going to be quick. Financing activities relate to transactions involving a business's owners or lenders. In this case, we're dealing with lenders because we have proceeds from long-term borrowings of $20,000. And the number is very simple to calculate. We take the closing balance of long-term borrowings in the current year balance sheet of 100 and we take away the closing balance from the previous year of 80. 100 less 80 is 20. So we have a net cash inflow of $20,000 from financing activities. Now let's take the total of all these cash inflows and outflows that we have worked out. We can see that the Cannons have a net cash increase of $35,000 for the current year, which ties to the movement in the cash balance, which we can see below, and which we can get from the balance sheet. The closing cash balance for the current year of 185, less the closing balance from the prior year of 150, gives us a $35,000 increase in cash. So there we have prepared the Chudley Cannons cash flow statement using the direct method, working out all of the numbers manually using the income statement and balance sheet. Whew, that was hard work, wasn't it? And this is only a simple example. You can imagine that this whole process is more complicated for larger companies with more complex transactions, which is why most of them actually avoid this process altogether, because it can be too expensive and time consuming for their accountants to work out cash flow using the direct method. The majority of large corporations tend to opt for the indirect method instead, which is the subject of our next video. The indirect method has the benefit of being much easier to prepare, however it's less useful to investors. And I'll explain why next time. Thanks for watching today's video. If you found it useful, like it, share it, comment, subscribe. I put out new videos every Monday here on Accounting Stuff. See you in the next one.